Let me be crystal clear before we start. I will never ask for your money. Never. Drop OG in the comments. One word. If these daily breakdowns are helping you think clearer and stay ahead of what the mainstream refuses to explain, I see the ones who verify. I see the ones who show up every session and do their own homework. The growth is real. Keep doing that. Never stop. Watch this fully. John OG builds these breakdowns so that the full picture only appears when you stay with the entire thing. That is intentional. If you want quick dopamine and easy narratives, there are plenty of channels for that. Moon merchants, hype dealers, algorithm farmers. That is not this. This is a room for independent thinkers. Act like it. Silver is sitting at $84 Western spot right now. If you watched Sunday's open, you saw the drop to $79, a $6 flush in the first hours of trading. And then what happened? It clawed every single dollar back and returned straight to $84. But here's the part that matters. $85 has now rejected 4 times. 3 times on Friday, once again today. The dollar gapped higher at Sunday's open, then came back into that gap. Silver still could not close above 85. That tells you something important. This is not a simple dollar story. That level is acting like a structural ceiling regardless of what the dollar is doing. Meanwhile, Shanghai closed physical silver at $96.85, up 1.7% on the session. Think about that. There is now a $12 gap between what Western paper markets claim silver is worth and what buyers in the East are actually paying for physical metal. And that gap did not close even on a day when global risk assets were getting hammered. That should get your attention. Because what the silver market is doing right now is structural. The pricing mechanism is slowly shifting from paper-driven Western trading toward physical-driven global demand, particularly out of Asia and industrial users. COMEX is not disappearing tomorrow, but its monopoly over price influence is eroding in real time. Shanghai Futures Exchange, silver vaults shed another 3 metric tons Monday, bringing inventories down to roughly 8.1 million ounces. And despite the violent price swings we saw in January and February, no meaningful metal has arrived to replace what was pulled. Paper markets can manage a price. They cannot fabricate warehouse inventory forever. The physical side of this market is telling a completely different story than the headline price most people see. Gold closed flat in Shanghai today around $5,123, while Western spot sits near $5,008. Gold is holding structure even with everything hitting the system at once. Palladium closed down just over 2%, platinum down around 1.4%, and that relative weakness matters. When stress enters the system, the hierarchy of hard assets becomes very clear very quickly. Gold first, silver second, industrial metals last. Now you cannot understand what happened to metals today without understanding what happened in oil overnight. And if you watched Sunday's breakdown from John OG, none of this should have surprised you. The tape reading objective on Friday was $95 WTI. At the Sunday open, crude gapped straight to $98. Objective cleared immediately, and then it kept going. WTI surged all the way to $120 at the peak. That is roughly a 30% move in less than 24 hours. Once $95 broke and held, the path to $100 became easy. Exactly what we discussed. The trigger was the closure of the Strait of Hormuz, setting off the worst global energy shock since the 1970s. Bahrain's state oil company declared force majeure after an Iranian strike ignited its only refinery. Iraq's production collapsed nearly 60% as tanker movement was blocked. Saudi Aramco halted operations at the Ras Tanura refinery, rerouting supertankers through Red Sea facilities to bypass Hormuz. But here is where the story gets bigger than oil. If WTI holds near $120 for 3 months, US CPI inflation could climb toward 3.7%. That would be the highest inflation reading since September 2023. Now think about what that means for the Federal Reserve. You cannot cut rates into rising inflation. You cannot hike rates into a war-driven economic slowdown. That is the trap. And the bond market is already trying to price it. Yields are mixed right now, not because traders are confused, but because the market is attempting to price inflation and recession at the same time. When the bond market cannot decide, that is not noise. That is the system telling you there's no clean resolution. But then something else happened. Exactly the psychology John OG warned about on Sunday. The most obvious trade in the world became oil going higher. Everyone saw the Hormuz closure. Everyone saw the refinery attacks. Everyone saw the headlines. And when everyone sees the same trade, markets have a habit of punishing it violently. The G7 and the International Energy Agency announced a coordinated release of up to 400 million barrels from strategic reserves. That headline was the trigger. Oil dropped 18% off its high in under 4 hours. WTI collapsed from near $120 back below $100, one of the largest single-session reversals in modern crude oil history. This is exactly why John OG repeats the same rule over and over. You do not chase gap opens, You do not buy vertical spikes. You wait for structure. Anyone who chased oil at $120 learned that lesson today. Those who waited are now watching with a much cleaner read on the next move. Here's the context most people ignore. Global oil demand is roughly 100 million barrels per day. A 400 million barrel release equals about 4 days of global consumption. The IEA nations collectively hold around 1.2 billion barrels, so that announcement represents nearly 30% of their reserves. Meanwhile, 20 million barrels per day normally move through the Strait of Hormuz, meaning that 400 million barrels only offsets roughly 20 days of disrupted traffic. That is not a long-term solution. That is a temporary window. And even that window is not confirmed. France's trade minister stated that the G7 is not yet fully aligned on actually releasing those stockpiles. 3 countries support it, others have not committed, which means the move that knocked oil down 18% was based on the possibility of a release, not the confirmation of one. France also announced the deployment of 8 warships, 1 aircraft carrier, and 2 helicopter carriers to the Mediterranean, Red Sea, and Strait of Hormuz, a ship escort mission designed to attempt reopening the route. India, meanwhile, publicly stated it will not release its strategic reserves, and Iranian oil is still moving. Satellite tracking shows shipments flowing primarily east toward China. The geopolitical architecture here is not simplifying. It is splitting.